I think the economy is in far worse shape than, the conventional wisdom would suggest. Certainly Wall Street, the Biden administration, the media are spinning the economy into something that it's not. I think the statistics, are very misleading, especially if you just accept them at face value. A lot of the statistics that purport to support a strong economy, I think, are going to be revised down. I don't even have any confidence that the numbers are going to hold up. I've been pointing out, and you may recall, that the 2008 Great Recession wasn't called until December of '08, and they said it started in December of '07. So they went back for an entire year and redid all the data. And the data previously had shown that the economy was good and it was growing and everything was great. And then they went back and said, you know what, all those statistics were wrong. We've actually been in a recession for an entire year. So there is a precedent for doing that. And I wouldn't expect those type of revisions to come until after this election, right? There's no way Biden's going to come out and admit that we've been in a recession for the past year or two. But they may ultimately acknowledge that once, the voters can no longer, react to it. But also, it's not just that the numbers may be revised. I think the numbers as they stand now don't even support that the economy is strong. One of the things that they look at is the job creation, and they point to all these jobs that are being created. But what they don't acknowledge is they're all part-time jobs. On balance, full-time jobs are being destroyed. We've lost full-time jobs. And you know that by looking at the household survey rather than the establishment survey. And there are few people who have full-time jobs today than who had them several years ago. What's happened is a lot of people now have 2 or 3 jobs. And the jobs that are being created are second and third jobs that are going to people who already have jobs. Now, the question is, why are people working second and third jobs? Is that something they want to do, or is that something that they have to do because they can't survive on one job anymore? And I think it's the latter. And so if an economy is so weak, if a labor market is so weak, that people are forced to give up their evenings and their weekends and take second and third jobs. Is that a sign of strength? No, I think it's a sign of weakness. People would rather not have these jobs, but they have no choice because the cost of living has gone up 30-40% since Biden took office. And that is a huge jump. And so the only way people can pay the rent, put food on the table, keep the lights on, right, pay their insurance, is by taking on additional jobs. Now, another way they're doing it is by tapping into their savings, what's left of the stimulus money they got during COVID. The savings rate has plunged, and credit card debt is at an all-time record high, despite credit card interest rates being at an all-time record high. So would people be running up their credit cards with record high interest rates if they had a choice, if they didn't need to do it? I mean, a real strong economy, people would be paying off their debts. People would be building up their savings. And if you look at the government statistics, you've got record high budget deficits, record high trade deficits. This is not a sign of a vibrant, growing economy, but a weak economy that's surviving on debt and imports. But I also think another key measure is the low popularity of Biden and Harris. Biden is the most unpopular president since they've taken the polls, right? So I don't know when they started, but he's the lowest. And Kamala Harris is the most unpopular vice president ever. Now, why is she so unpopular? I mean, what has she done? I mean, she hasn't done anything, but the vice presidents don't really do anything. But why are the Biden and Harris so unpopular? Well, the answer is because the economy is lousy and they're getting the blame. And in fact, when you look at the polls, where Biden scores lowest is on the economy. And what's the main problem is inflation. Inflation is robbing people of their purchasing power. And the reason we have so much inflation is because we have so much government. An inflation problem is a government problem because government pays for spending by creating inflation. The central bank helps the government by monetizing debt, quantitative easing, keeping interest rates artificially low, to stimulate a demand and consumption. And this is why prices are going up. And these higher prices are a tax, and the average Americans and the poor are feeling that tax bite, far more than the rich. And so, maybe Biden still has the support of some of the rich people who have gone wealthy from inflation because they own assets and they don't care if it costs them 40 or 50% more to buy groceries because they don't even pay attention to their grocery bill because it's such a small percentage of what they spend. but people who are clipping coupons because groceries take a big bite out of their paycheck, they're the ones that are feeling this. So the economy is bad, and it's going to get worse. That is the reality, because the inflation problem is going to get bigger. It's not solved. It's not going back down to 2%. It's already headed back up in the other direction. Long-term interest rates are going to be pushed higher by rising inflation, and that's going to compound the problem. And I think it's only a matter of time before a lot of these part-time jobs are eliminated, and we're going to start to see an official increase in the unemployment rate, which is going to be very problematic, because now it's going to be stagflation. I mean, I think we're already there, but now the statistics are going to bear that out. The central banks spent over a decade flooding the economy with inflation. We had QE1, QE2, QE3. Interest rates were at zero for more than a decade. And so they really primed the pump. And so over the last couple of years, we're just starting to see the delayed reaction in the pricing structure to all that inflation. And so we've got years and years of catching up to do with respect to the monetary policy mistakes of the past. We haven't even caught up to the mistakes of the present. But the Fed never really moved interest rates into restrictive territory. I mean, it claims it did because it got them up to 5.25, 5.5. But if you look at where rates have averaged, since we went off the gold standard in 1971, rates are lower than average. You just have to throw out the period from the 2008 financial crisis to 2021, when they were ridiculously, unprecedentedly low. But if you compare the rates we have now to the 90s, to the 80s, to the 70s, to the 60s, they're low. They're not high. And if you compare them to the inflation rate, they're not high. But also, if you understand that the way rate hikes are supposed to reduce inflation is by reducing demand. And they do that by increasing the cost of borrowing money. And so there's less money borrowed and less money spent. And it's the reduction in borrowing and spending that takes the upward pressure off prices. But even though the Fed has raised rates, government borrowing has accelerated to record levels, and individual household borrowing has accelerated to record levels. So thus far, the rate hikes have been inadequate to actually fight inflation. What we need are much higher interest rates, but the Fed won't supply them. It's not an accident that the Fed stopped hiking after Silicon Valley Bank, Signature Bank, all these banks failed, right? That was the warning sign. Okay, we've raised rates. We can't keep raising them anymore because we're already causing these bank failures. If we raise them anymore, more of these dominoes are going to drop, because the whole banking system is really insolvent because rates were so low for so long. All these banks loaded up on long-term treasuries and mortgage-backed securities that are now underwater. And they'll be even deeper underwater if the Fed keeps raising rates. So in order to stop a financial crisis and subsidize the U.S. government's ability to pay its debts, that's why the Fed stopped hiking. Not because they finished the job fighting inflation, but because if they kept fighting inflation, they were going to destroy the economy and the financial system in the process, so they backed off. But I think the way we're going to get from here to the election is at some point the Fed is going to come through with some rate cuts. They shouldn't. I mean, they should be hiking rates, but they won't. But I do think the economic data is going to soften between now and the election, and that will provide the cover for the Fed. Because if the unemployment numbers pick up, if the job creation slows down or turns negative, the Fed can claim that this justifies the cuts, because they'll also say that this weakness in the economy and the labor market is going to bring down the inflation rate in the future. So even if inflation is still 4 or 5%, maybe the way they measure it, if they get a weakening economy, they can say, look, we know inflation is still above 2% now, but we have confidence it's going to go down because of the weakness in the labor market and the economy. And so therefore, we can turn our attention now to the economy and labor market. And, we don't have to worry about inflation anymore because that problem is solved. But what they don't realize, or they don't want to admit, is the next recession is going to exacerbate the inflation problem, because the next recession is going to take these enormous budget deficits and make them even bigger. And so even more money is going to have to be printed to finance it. And that's going to put tremendous downward pressure on the dollar, which we haven't even seen yet. And then that's going to put even more upward pressure on consumer prices. So it's going to be an inflationary recession stagflation, inflationary depression, however you want to define it, but it's not going to be like any of the economic environments that we've been in since the 1970s, except this time it's going to be much worse than the 1970s. Inflation has been the drug that the Fed has used every time the economy turns south, which obviously it's going to do again if it hasn't already done that. But meanwhile, because of all this, we're now spending over $1 trillion a year just on interest on the debt. And if rates just stay where they are, sometime next year, we'll be spending more than $2 trillion on interest on the national debt. Not rate hikes, just if they stay where they are. And so right now, interest is the third biggest line item in the budget. It's more than defense. But by the end of next year, 2025, if rates stay where they are, it'll be the biggest line item. The U.S. government will be spending more paying interest to bondholders than it does making Social Security payments or Medicare payments. Just imagine that as the biggest government expenditure. And of course, it doesn't stop there, because if this continues for another few years, that interest expense keeps growing to the point where before the end of this decade, the U.S. government will be spending 100% of what it collects in taxes just paying interest on the national debt. Now, obviously, we can't get to that point. There's no way the bond market, the currency market, is going to allow the U.S. government to get to the position where all of the tax revenue goes to paying interest on the debt, right? And we have no money for anything, right? Not even to pay the people to send out the checks to the bondholders. We won't have any money. You know, that means that the government would have to borrow 100% of the defense budget, Social Security, Medicare, everything. So sometime between now and then, this thing has to collapse. The question is when, right? Do we have the crisis this year? Do we have it next year? Do we have it in 2026? But every year we don't have it, the odds of it happening the next year grow up.